This is video 5 of example 8 dealing with the category financial assets at amortized cost. We have looked already at the day 1 initial recognition and the measurement of the debenture. We are now at the end of year 1, at the end of 31 December 2011, and we need to recognize the interest that has accrued, that the company has earned, the proceeds that they have earned, or the return that they earned on the investment, the interest. And that is done according to the effective interest rate method. How do I calculate that interest? You calculate it by using the balance in the investment times the effective interest rate. Remember, we had to calculate a new effective interest rate because of the transaction cost. So your interest that goes to finance income in profit or loss is the balance on the investment times the effective interest. That is your effective interest rate method. So it is interest income or finance income. You are investor, you are earning interest, and the contra account is your investment in the debenture. Think back to what you guys did in IFRS 16 in leases. You bring in the interest. And what happens next? The next journal entry is then any payment that took place. What payment took place at the end of year 1? The interest payment. We as investors received some money in the form of interest. So debit bank, we received money. What did we receive? What we received is nominal value times nominal rate. What was flowing in cash is 100 Rand, and we credit our investment in debenture with that 100 Rand. Again, think back to how you did it in IFRS 16. You added on the interest and then deducted any payment. In this case, the payment consists only of interest. So now you can calculate the new balance left in the investment account. It is the day 1 balance. You added the interest that was earned, the interest that accrued on this investment, and you deducted the payment. So the balance in the T account, if you were to draw a T account, would be 1,078 and 3 cents. So what happens now in year 2? Well, we get to the end of year 2, 31 December, and first of all, we again have to recognize the interest that accrued, the interest that was earned on this investment throughout the year. How do I recognize it? According to the effective interest rate method. So I calculate the interest, the finance income, because I'm an investor, I'm earning interest based on the balance in the T account, which was the balance at the end of the prior year, that total balance accrued interest for this year, and I multiply that with the effective interest rate. Remember, we had to calculate an effective interest rate because of the transaction costs. So balance in the T account times the effective interest rate is the amount of interest you will recognize as finance income, and the contra account is your investment in the debenture. Again, think back to IFRS 16. You first bring in the interest and then you recognize the payment. Now, in this case, 2 payments take place on 31 December 2012. The first payment that takes place is the interest. There's a debit bank, a cash flow happened. How much interest did we receive in cash? Nominal value times nominal rate, 100 Rand, and we credit the investment in the debenture. but there was also a maturity payment on this date. So again, we receive money, we receive some capital back, the principal payment. We already looked at the cash flow calculations. We know that we receive 550 Rand, contra account the investment in the debenture. Now we can again go and calculate what is the remaining balance in this T account. So where we started at the beginning of the year, then we added the interest that accrued, we deduct the interest that paid, and we deducted the capital payment. What is left in our debenture account, the balance at the end of the year, 542 Rand and 44 cents. What happens now in 2013? Exactly the same again. We get to the end of the year, 31 December, and we need to recognize the interest that was earned or that accrued throughout this year. So the finance income. How do we calculate that finance income? We use the balance on the T account, which was the balance at the end of the prior year, times the effective interest rate. This is the effective interest rate method, balance times effective interest. Remember, we calculated that effective interest. That is the first thing that happens on 31 December. What else happens? There's also two payments. Interest get paid and a maturity payment. So the first one is the interest payment. We receive interest, nominal value times nominal rate is the interest you receive in cash. Just remember, it is less than the prior years because some of the nominal value already matured. It is the outstanding nominal value, the remaining nominal value that accrues interest. The second payment that happens is the maturity payment, debit bank. We already calculated that amount of 550 contra account investment in debenture. Now, if you worked correctly and you did all your interest rate calculations and everything correctly at the end of this year, now that the debenture has matured completely, has been redeemed completely, you should not have an investment anymore. It is redeemed, matured. It is no longer there. No amount is outstanding. So your T account should actually be 0 Rand. In this case, there was a rounding difference of 1 cent, but there should be nothing left in your debenture T account. It has matured. The full amount has been paid back.